Hi everyone, Joe Gentili from Left Tail Risk Advisors. Today I want to go through something that I think is really important for a buyer of life insurance to understand in order to make an informed decision and to protect themselves. And so life insurance policies are first and foremost legal contracts. And those legal contracts lay out what the insurance company has to do, and it lays out what the policyholder is bound by. And that contract is going to have guaranteed elements to it and there's going to be non-guaranteed elements to it. And unfortunately, I think today, life insurance policies and I think policies that are oversold tend to be oversold based off those non-guaranteed elements. They're really highlighted because non-guaranteed elements and projections and illustrations based off those can make outcomes on policies look really, really good, even though those outcomes may not be very likely to happen at all. So, my personal philosophy on insurance is that insurance should be bought primarily for what it will do, not what it can do. So, I personally think that people should, of course, they should pay attention to the non-guaranteed elements. I'm not saying they're not important, but I think primary focus should be on the guaranteed elements of the policy. And when we look at different types of life insurance, there's different things in them that are guaranteed and not guaranteed. And you have to look across the spectrum of different types of life insurance. So if you look at, let's start with the simplest type, term life insurance. Term life insurance is mostly guaranteed elements of a policy where you pay the policy premium and the policy stays in force as long as you pay the premium. And most people are buying 10-year, 20-year, 30-year level term policies. And as long as you pay that premium amount, the policy stays in force. Where you get some variability in those policies is in the conversion privileges. That a conversion privilege is the right without medical underwriting to turn that turn that temporary policy into a permanent one. And some insurers will guarantee that you could convert into any permanent policy they have or to certain named types of permanent policies. And other carriers, it's non-guaranteed. They may let you convert into a permanent policy, but the permanent policy that you could convert to is it's a little vague as to what it is, and so that leaves some carrier discretion there. That's the simplest. Then we go to the permanent life insurance policies, whole life insurance policies. Whole life insurance policies issued by dividend paying mutual companies. One of the most attractive features of those policies is just how much is guaranteed in them. There's not a lot of moving parts in a whole life insurance policy contract. Most things are nailed down. The cost of insurance, the premium, that's all nailed down. The part of the policy or the main moving part that isn't nailed down, that's non-guaranteed, is the dividend. So the dividend is the one thing that you have to focus on with whole life insurance that is not a guaranteed element. Fortunately, with the larger dividend paying mutual companies, they have very long track records of paying dividends, over 100 years in most cases. So while it's not guaranteed, you can look at a very long period of time to just see how that dividend behaves in certain situations. But you want to be mindful that when you're looking at an illustration for a whole life insurance policy, the dividend is not a guaranteed element, and the policy could perform better or worse than the non-guaranteed um, columns on an illustration are showing you. So you want to be aware of that. When we go over to the universal life insurance side of the spectrum, guaranteed universal life products, they obviously have guarantees in them, as the name says, that doesn't exist in other types of universal life insurance policies. And that guarantee is usually for a set amount of time, and that amount of time can range from life to a relatively short period of time. As long as you pay the premium, the policy stays in force. So you have guarantees there that exist in those policies that are very valuable that don't exist in other types of universal life insurance policies. Those guarantees may be very delicate. Whole life insurance guarantees are very robust, especially in later years, because there's a lot of cash value to back up those guarantees. But with the guaranteed universal life insurance policies, they can be delicate where if you miss a policy payment or you're late with a policy payment, you can invalidate the guarantee and you could end up then with non-guaranteed pricing, which can be very expensive. Finally, when we get to index universal life, I'm going to use as an example. Those policies are very frequently sold, emphasizing the non-guaranteed elements of those policies because not a lot is guaranteed in those policies. There's a reason why they're sold that way. The cost of insurance within a very wide range is not guaranteed. So the life insurance company can raise the cost of insurance within those policies within a very wide band. So they can make those policies very expensive. The administrative costs on some policies can be changed. They can be adjusted upwards. When you're getting to the indexes and how those indexes perform, the availability of any given index is typically not guaranteed in the contract. The caps put on those indexes and the participation rates in those indexes, those are also subject to change. Those are not guaranteed. The loan rates or the spread that is shown on illustrations between the crediting rate and the loan rates, that's not guaranteed either. So you have a lot, if not most of the elements of those policies that are not guaranteed. Sometimes they're not guaranteed to such a degree that they really only exist within the whim or the pleasure of the life insurance company, and they're able to change these things at any point that they want. When you're buying an insurance policy from a company selling index universal life, inevitably part of the calculation has to be, do you trust this insurance carrier to behave ethically? And one of the risks that I see with that is that even if a company's management today is ethical, if the company culture is ethical, a life insurance contract is a very long contract. Hopefully, you are going to have a policy in place for decades. So, because the management team and the culture of the company is ethical and cares about their policy holders today, that doesn't mean that 20 years down the line, 15 years down the line, that you're going to have the same owners of the company, you're going to have the same management, you're going to have the same culture. So, things change. So, it's important, I think, to look at the guaranteed elements of a policy first, because that is going to show you what you will get out of that policy. And then it's important to consider the non-guaranteed elements. They could deliver some upside. In the case of whole life insurance policies with dividend paying companies, there's a very long history of those non-guaranteed elements being delivered. So they're important to look at, but really focus on those guarantees. If you have any questions on this, please feel free to reach out. If you have a policy that you'd like us to review, please feel free to reach out. And if you found this video useful, I hope you like and subscribe for future videos. Thanks.